Hello, it's Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for September 1st of 2024. Well, I hope you all had a wonderful Labor Day weekend. Here we are for the first broadcast in the month of September. We do have a lot to talk about this week. We'll start off with the S&P 500. Usually we kind of start off with some economic data, and we'll follow up with that. But obviously the market activities over the last really the last handful of weeks has been very stout. You can see here in this left-hand chart, we've got the S&P 500 index. We had that correction of sorts towards the beginning of last month, and the ensuing resurgence. So you can see the 20-day moving average here. The 100-day moving average is in this green line. You can see that, from a purely technical standpoint, we're looking pretty good. We are testing some short-term resistance, and people tend to get a little bit more concerned when you test that longer-term moving average, and we're not close to that right now. But I do think stocks might be a little overheated. We've got some other technical indicators here on the market. On the right-hand side, we've got the number of stocks, percent of stocks above the 20-day moving average, which is this line here on this side. And you can see that number is very high. From a percentage standpoint, it's exceptionally high, and that's actually a good thing. It just means that there's more breadth in the market. There's better participation amongst the non-Magnificent Seven stocks. And I think, as we'll talk about over the course of the chart pack here this week, we're going to see some deceleration in earnings growth from the Mag 7 stocks relative to the rest of the index. And that's not to say that the Magnificent Seven is going to witness outright declines in earnings. That's not what I'm saying at all. I'm just saying that the relative earnings growth for the rest of the index and the relative price performance is apt to be much different than it's looked like over the last 12 months. And you can see here, even looking at it from a few months basis here, you can see that the momentum trend for those Mag 7s primarily, and this does really emphasize the Mag 7 effect here, and you can see that momentum is in a bit of a decline right now. Again, nothing to be concerned about, scared about necessarily. It's good to have greater breadth across the rest of the index. Here we have an indicator, two indicators actually, of some of the volatility that we've seen over the last, particularly emphasizing over the last month, but really as you look over kind of an extended period of time, right here, we've got some data from UBS. We've seen really a lot of changes in expectations for Fed fund rates. And of course, expectations for interest rate cut here this month is very, very high. In fact, it's basically a foregone conclusion after Chairman Powell basically said as much at the Jackson Hole Symposium hosted by the Kansas City Fed. But here we have oscillations for Fed fund rate, and this is the implied rate looking forward, and obviously that's changed a lot. And I think notably too, this is very important but relatively understated, is that option volumes on the S&P 500 have really moved up considerably. And I think that's something that we should very much pay attention to, because it has the capability of introducing a lot of volatility. When you're placing essentially leveraged bets on the market and you're enhancing those bets, it always creates the opportunity for a little bit of volatility. We have some historical context here. And so, the good news is, when we look at everything on its face, even though the market may be a little stretched, we saw that from some of the momentum indicators, from some of the moving averages, it's not a bad place to be. But typically when you have that first rate cut, and again, we are very likely going to have that first rate cut this month. And so if you go back and look at all of these different instances where we had rate cycles emerging, new rate cycles emerging, that really there's only a couple of instances where we witnessed a decline. Obviously, we were in the midst of the tech bubble here, and that was a rather prolonged, difficult market, as was the September of 2007. And this is really on the eve of the global financial crisis. And this would be the ensuing 12 months after the rate cut. So this is essentially looking into 2021, or excuse me, 2001. And this is really looking into the heart and the guts of 2008 when we had all that trouble. But if you back that out, and again, that's not to say that these instances aren't important, but the preponderance of the data is that once you get a rate cut, that you typically have positive stock returns, and you have, in some cases, rather meaningful stock returns. And so, you look at this, you look at this through two different lenses. One, rate cuts represent an easing in financial conditions and credit conditions in the economy, and that tends to spur economic growth. But looking at it through a different lens, when you're in a rate cut scenario, it could also imply that you're on the eve of a downturn. And you could see, that was implicit here, whereas, the other instances that I mentioned were really reflected in this kind of positive reaction to those rate cuts. Here's looking at that rate cut issue in a different way. You've got basically looking at this band of the 25th to 75th percentile of outcomes, looking at this, over many rate cycles. And you can see that, true, there is a possibility in some instances where you get a recession out of that rate cut. Again, to my earlier point about sometimes rate cuts are a byproduct of witnessing a lot of slowing in the economy, that the Fed is behind the curve and trying to catch up. But you can see that just generally speaking, once you get that rate cut, that the majority of these outcomes are entirely positive. We have a little bit of a long-term view on balanced portfolios. I sent this out to my team when I first saw it, and it's just one of those, many reminders that if you are diversified, and in this case, this is just referring to 60% equities or 60% large cap stocks and 40% intermediate treasuries, that you're going to do fine. Your asset allocation is the most important decision you can make, especially if you have a long-term horizon. If you look at 10 to 20 years, this type of portfolio starting in 1926 and rolling all of those instances forward, and you realize that that is essentially 100 years almost, and that 100% of the time, if your investment horizon is 10 to 20 years, you're going to be making money. And even if you look at monthly returns, which unfortunately people still get bogged down in the monthly returns and even quarterly returns, and you really almost have to get out 12 months, and still there's a possibility of having a 20% probability of having a negative return in any one 12-month period. But again, the power in that diversification over long horizons is well entrenched and very well understood, and very well represented in this chart. Here we have some other data that I thought was really interesting. This pertains to companies within the S&P 500, within the economy in general. You can see sales growth in that solid line here, and that's a dark line. You can see sales growth is decelerating. It is still positive, 4.4%. Again, we've talked about this. Sales it represents the mother's milk of earnings, and you can't have earnings without sales. And if sales are decelerating, obviously you're going to take stock of that. But at the same time, we have expanding profit margins, and these will be operating profits. And so, it tells me a little bit that, even though prices seem to be moderating, particularly in the producer channel, that there's still optimization and productivity that's going on here that's allowing these margins to expand, despite the fact that you've got sales deceleration, because usually if you have less sales, you're not able to, if you had greater sales rather, you could spread those fixed costs of production or the fixed costs of providing a service over a greater revenue base, and that would implicitly increase your margins. But in the case where sales sales are decelerating, usually that works in reverse. And so you can see here the very good relationship here where sales and profits tend to follow each other. And this is a really interesting juncture here. And so, as I've said, in a lot of different things that have not necessarily made as much sense over the last 6 to 9 months, that generally there's going to be a reckoning here. And I feel like, sales might be a little muted perhaps, and then go back up. And I do think margins are probably going to, maybe come down a little bit, even though wage pressures are subsiding a bit. But I generally think that we're going to see something probably in the 8 to 9% range here on profit margins, and because profit margins are on the right-hand margin, and and then eventually we'll see sales come up. But right now we're in that sales deceleration. We have equity valuations, as I mentioned, might be a little stretched now with the resurgence in the market. Here we've got basically deviation from fair value. This is a BCA research, which does really good work on overall valuation, but it's not an absolute. So, it's one of those things that you look at and you say, yeah, I think there's probably some merit to the fact that the market is overheated. Is it a catastrophe? No, because most of the market is not overtly and not incredibly overvalued. Here we have a basically a depiction of value versus growth, and right now we have value being relatively cheap, growth being relatively expensive. I think that was really incumbent in that last chart by BCA research, and I think it's factored in greatly to the calculus of things. And this is where I say that, especially with the Mag 7 earnings not increasing at the same rate as they have, and you've got the other companies in the S&P 500, which frankly are contributing to that profit margin growth that we were just talking about. And it's created this scenario of where value stocks really have an interesting value at this point. And especially when you think about onshoring and you think about the reindustrialization of America, to support that onshoring, that's going to lead to a lot of capital spending, which is going to benefit a lot of companies that are not necessarily in the AI sector. And so I think this sets up pretty well for some interesting price movement for areas in the market other than the Mag 7. And here we have that particular issue that I was talking about with the Magnificent Seven. In the green, you can see, very strong earnings results for several quarters. And you can begin to see that deceleration here. Now, again, that's still very strong. But when you get into the third quarter, and we're going to get a lot of these reports starting about the middle of next month, that being October, and you got 16, 18%. Now, again, that's great earnings growth. I think anybody would take that at any time. And then my point, just to reemphasize it, was that I didn't think that earnings were going to fall off a cliff for the Mag 7. It's just that in that blue, you can see that earnings were a little bit more challenged, right? 9% is a good earnings number. 6%, honestly, is a pretty decent earnings number. But you take the average of all of these and you say, all right, well, it's kind of lackluster. Well, you can begin to see, some growth here. And, especially if you have this breakout in the fourth quarter, you're going to see some stock price movement in this non-Mag 7 parts of the market. Here we have Mag 7's contribution to the overall S&P 500 earnings. You can see NVIDIA. This is actually almost ridiculous to talk about how important NVIDIA has been to the index itself, which, again, let's be honest, the S&P 500 is not your father's index anymore. It looks totally different and has totally different volatility characteristics and beta and price to earnings ratio characteristics than it did 10 years ago. But here's NVIDIA, here's the other Mag 7, and over time, we're going to get much more contribution from the rest of the market. So now is a good time to be looking at those other sectors. Now, we should be talking about the dollar as well. Dollar's in the red here, the DXY. That's the trade-weighted dollar number, and we know the dollar's been in some decline. Obviously, we are lowering rates, and there's other parts of the world that are not as as enthusiastic, I guess, perhaps. Although there are some that have beat us to the punch here, but the dollar has weakened at the same time that the S&P 500 has gone up. And as you can see here, just looking at it over the last year, we've seen a bit of a deviation. And I do think the dollar is probably going to hold up. I think some of it will depend on how big of a rate decrease we get. And I think right now the consensus probably is looking for about a quarter point. And so dollar's kind of sold off a little bit on that basis, and I do think the dollar kind of holds its value here, even if the S&P pulls back a little bit. Something else I thought was extremely interesting, and we've talked about this quite a few times, and how it relates to volatility and how it relates to price movements. That we have households now that own almost 40% of the entire equities market, and this is through through a lot of different vehicles, but you can see the breakdown of the rest of that. We have increased foreign ownership. Again, we've had a strong dollar, so you've got those foreign investors that want not only the best market in the world, but they also want access to those increased returns on a currency adjusted basis. But households, very important to the equation here, and that's something that has really developed over the last 15, 20 years. This chart represents the junk bond. This is the SPDR high yield bond junk JNK. This is the JNK ETF, but it's the high yield ETF here. And you can see prices holding up quite nicely and have for quite some time. If you get past the post-pandemic era, they've been real stable to up. The line of best fit here, looking back over the last 2 years, has been definitely upward sloping. What that tells you is there's just not a lot of fear in the credit markets right now, and credit spreads are very tight across the entire spectrum. Now we've got a few charts coming at you from FS Investments. Really, their piece and their thesis is that the private markets, and especially private credit, really well positioned here. And we're going to talk about that because it was a very good piece. So you see here, you've got C&I loans as a percent of total bank holdings. And the fact that this has been decelerating since 1990 tells you that we've had the emergence of what we'll call the non-bank sector, that we have financing from other means, basically. Now we look at commercial banks, and this is something that I have mentioned before, something that clearly has been going on for quite a while now, and we see the number of financial institutions, namely, more specifically, commercial banks, go from basically around 12,000 to 4,000. So we've had, essentially an 8,000 unit decline in the number of commercial banks in this country. And here, if we go all the way back to 1988, you can see the growth in the number of private companies. Obviously, we've had a lot of new company formations, and those companies have thrived and continue to grow. Well, at the same time, we've seen a 35% drop in the number of public companies, the number of publicly traded companies, and the supply. We call this kind of the supply of equities on the public market has gone down quite a bit to the point where we're talking about just a handful of thousands of companies, and then basically as a result of since 1988, we've had a 35% drop in the number of publicly traded companies. And then we've had a corresponding 43% increase in the number of private companies, which makes a much greater subset If you're looking to lend, you're obviously going to be looking at the private markets a lot more, and it's a tremendous opportunity to invest in private companies, which are much more numerous than their publicly traded counterparts. Something else that we've talked about is the condition of private equity right now, and we do hear of some funds kind of struggling to liquidate portfolios, but we know that they have a lot of dry powder, and this is clearly an evidence here. This is something that's been evolving over the last several years now. We had kind of almost a plateau or slow growth for a number of years heading into the pandemic, and then afterwards we've seen, at least in the U.S., really strong growth here. And if you look globally, there's a lot of dry powder in the private equity industry that is looking for private companies to acquire. Here we have bank lending for C&I loans, and then this really emphasizes my point that we've seen a true emergence in the non-bank sector. So when you think about commercial banks for commercial and industrial or C&I loans, I mean, you've actually seen kind of a net drop, if you will, in bank lending for C&I loans at the same time that you've seen growth in overall GDP, and you've seen basically the growth in the economy here. And so this intuitively, if you're growing your economy, you're growing your expansion capital for the companies that are generating that growth. And obviously that a lot of that is not coming from the commercial bank sector right now. Here we have another look at that gap. You've got basically a change in bank loans and leases, which has kind of lagged the overall expectation. And this is driven off of the Federal Reserve numbers. And so they estimate that currently there's a gap of almost $500 billion here of lending that's not happening from the commercial banking sector. And then this is obviously your growth in the GDP. And so, if you extrapolate the ratios that have been well entrenched, over a longer period of time, and in this case, over a short period of time, that you would think that there'd be at least another $500 billion of lending in the channel, and maybe coming from someplace else. That's really the point. We have a net number of U.S. banks that are still in tightening mode. So if you look at this chart, basically you've got a net number of around 20%, call it, of the banks are still tightening. So we've seen obviously a period after the pandemic where they were very, very loose as they were prior to the pandemic. This is a point where we were really concerned about the economic backdrop, as it were, back in 2022, because a lot of banks were pulling back in. But you can see that easing has been taking place, but on a net basis, they're still tight. So this is another chart highlighting the amount of dry powder that's in the private capital markets. You can see some of the big players here represented in this chart. You can see that even looking at it year over year from 2023 to 2024, that for many of these players, that their cash balances have continued to grow, which provides a tremendous amount of lending power and investment power in the overall markets. A quick check-in here on housing. No surprises here. We had some more recent Case-Shiller data, which shows that prices continue to climb. You can see that here in the blue line, which is helping to keep a lid on housing affordability, even though mortgage rates are coming down. So, this is something that will, I think, limit our growth to some degree over the next 12 months and perhaps even beyond, that we really do have a conundrum in the housing market right now. Now we'll talk about the most recent revision in the second quarter GDP report. We got the first reading in July for the second quarter ended June 30th. So we just got the first revision of that, and we'll get one more before it's deemed final. But that number was revised up, so about 0.2%. And most of that came from consumer spending. You can see that that line here was really outsized, and there were some net negative revisions in some other areas, inventories and government spending. As we look ahead, net exports is actually probably looking a lot stronger in the coming quarter. We'll talk about that in a second. Government spending, we know with higher interest costs, that will be crowded out, and we don't think government overall is going to be spending like it has. Inventories, we know that spending is going up. We'll talk about that in a second because that is related to net exports. And then housing, we know, is been a drag and likely to remain a drag. Business investment is kind of curious because we know companies have a lot of dry powder, but they are cautious. Guardedly optimistic, I think, might be a better term for it, looking out over the next 12 months. Well, I've already talked about the GDP report and the influence on consumer spending on the revision. And you can see as you track quarters on a sequential basis, you can see the uptick, and then goods spending, consumer spending on goods, I should say, was a net positive where it had been a drag in the prior quarter. And you can see that obviously had net goods spending been positive, that likely we'd see GDP that was kind of like, relatively consistent along these lines, around 2% on a annualized basis. Looking at over here, we can see the contributions to real GDP by sector. Again, the gray area represents consumer spending, and that was the biggest influencer here in the most recent quarter. Here we have trade balance in goods, and that is net negative. That just means we're importing more than we're exporting. And you can see here that inventories are trending higher. And this is why I think, that in the third quarter, GDP is going to be enhanced by inventory acquisition. And the thing that's going on here looks like we might be on the precipice of some more supply chain choke points, port congestions, things like that. And you've got retailers that are trying to stock up for the holiday season, trying to tap into that consumer purchasing power that we just talked about being so strong in that first revision of the GDP report for second quarter. And what that is doing is causing inventories to grow, which I think will continue to happen. And also, it just means that we're importing more, trying to get ahead of any choke points related to port closures or things of a logistical nature. So here we have kind of an outlook from the various markets, and you try to read the tea leaves of what the markets are telling you about where they think the economy is going to go. And so we've talked a lot about this notion of a soft landing, and I think we are in it right now. But what's interesting is you have a lot of optimism in the stock market. Bonds, as it were, are a little bit more circumspect. I think this is a terrific word for that right here from Bloomberg. So bond markets tend to get it right more than the stock market, and so I don't mean to scare anybody with that, but I think I think there's just a lot of optimism built into the equities, and some of that I think has to do with the Mag 7. And again, once we have that little handoff, if you will, to more cyclically focused stocks, and this number comes in, I think what we're going to find is this number is really going to settle in. And bonds are going to be, their caution and circumspection, I think, will be well warranted. But again, this still implies that we're going to have a soft landing, but it just implies that it's not with the degree of enthusiasm that I think has been built into the equity markets. Quick check-in on wages. We see wage growth decelerating. This is the Atlanta Fed's tracker. And again, this is, it has its various implications, right, for consumer spending. If wages are going down, then that means that perhaps consumption might stall a little bit. But we do know that inflation is well below wage growth. So real wages are still moving higher, which is adding to consumption power, if you will, and although not necessarily savings, but definitely consumption at this point. But but from a producer standpoint, and if you look at it through an employer lens, these costs coming down are certainly a benefit to you. It helps your margins, it helps your earnings, so on and so forth. Well, that's all we have for today. Hope you've enjoyed it. Have a great week, and we'll talk to you again soon. Take care. Bye.